Good afternoon. Welcome today to our program entitled Impact Investing in Social Enterprise, New Developments, Challenges, and Opportunities for Nonprofits. My name is Jeff Tenenbaum, Chair of the Nonprofit Organizations Practice here at the Venable Law Firm. And as many of you know, this program is part of the monthly series we've been doing for over 6 years now on a wide variety of different nonprofit legal topics every month. Although, as you may have noticed, we did take the summer off in July and August. So we welcome you back to our program here today. And we have been busy over the summer planning a full series of programs for you over the coming months, which I'll preview for you in a minute. We have a full house here, about 100 folks in our D.C. offices enjoying some lunch and here for our program today. I think we have maybe approximately 300 folks registered on the webinar portion of the program today across the country. So welcome to all of you joining us remotely. As many of you know, these programs are all recorded and they will be available. This one will be available tomorrow on our nonprofit YouTube channel. The link to that channel is on the last slide of today's PowerPoint presentation. And all of you will receive an email tomorrow that contains a link to the recording as well as the PowerPoint slides and handout materials. A few housekeeping items before we get to introducing our speakers. First, for those of you from the Trade and Professional Association community, these programs are eligible for CAE Continuing Education Credit. This is a preview of our upcoming programs. We have quite a bit to tackle in the next few months, and I hope you'll be able to join us for some or all of these programs. In October, our program is entitled The Top 10 Tips for Nonprofits to Consider When They Procure Technology Solutions. November's program, Key Safety and Security, both physical and financial risk management strategies for U.S.-based nonprofits operating overseas. December's program is going to be on performance management, getting the best out of your nonprofit's workforce. Come the new year, we're going to tackle the top privacy and data security trends and issues for nonprofits in 2018. And finally, in February, our program is entitled Nonprofit Mergers, Alliances, and Joint Ventures, Options, Best Practices, and Practical Tips. For virtually all of these programs, all but one, we have a terrific lineup of outside speakers as well as Venable lawyers. Today's program is one of the few that we've done with all outside speakers, although these are all folks that we get to work with quite a bit, but we're really thrilled to have them here today, and I'll introduce them in a minute. But we're trying to mix in as many outside speakers with Venable attorneys as we can to give kind of a broader range and perspective and broader context on these issues that we're tackling, and we hope that you enjoy that. In terms of handout materials, those of you in the room have a printed booklet that has a copy of the PowerPoint slides from today's program, along with full speaker bios and some ancillary handout materials. Those of you on the webinar, there's a link in the confirmation email you received where you can pull up the PowerPoint slides. And as I said, you'll all get an email tomorrow with a full recording of today's program and all of those materials. For those of you in the room, when you want to ask questions, and we encourage you to ask questions throughout the program, just raise your hand, but please wait until one of the two microphones comes to you so that everyone on the webinar can see and hear you ask your questions. And for those of you on the webinar, please pose your questions to me using the chat feature on the webinar software, and I'll pose those to our speakers at the appropriate times. We do have a lot of material to cover today on a really hot and very interesting topic, one of the kind of richest, most interesting topics that I think that we deal with as nonprofit attorneys these days. And so bear with us as we struggle through the content today. Now, our terrific speakers, and I'm so grateful that all of them were able to join us today. The three of them are really rock stars in the world of nonprofit impact investing. Like I said, I have the privilege of working with all of them. They're absolutely incredibly knowledgeable, very experienced in this area, and you're really going to benefit from their wisdom and insights today. To my immediate left is Camille Cook. Camille is Associate General Counsel for Corporate Services at the Nature Conservancy, a nonprofit corporation established to protect and conserve the lands and waters on which all life depends. In this role, Camille is responsible for advising the Conservancy on its conservation investment activities, including structuring and managing joint ventures with for-profit companies, designing conservation investment funds, businesses and accelerators, broker-dealer regulations, and ensuring that the Conservancy conducts these activities in full compliance with tax laws. Full bios for our speakers are in the handout booklets. To Camille's left is Javid Fruzan. Javid is Vice President of Research, Business Development, and Strategic Alliances for the Leukemia and Lymphoma Society. Javid leads the business activities of the LLS research team in support of LLS's research mission for the LLS Therapy Acceleration Program, otherwise known as TAP, and the LLS grant programs. Representative funding transactions include convertible notes, equity, and research collaborations. His corporate development experience spans over 25 years in early stage growth and large biopharmaceutical and health technology firms. And last but not least, to Javid's left is Tracy Carter. Tracy is Director of Social Investments at the Annie E. Casey Foundation. Tracy leads the Annie E. Casey Foundation's social investment portfolio. The foundation has allocated 4% of its endowment to investments that achieve a financial return, as well as social returns that build brighter futures for children in the United States. In her tenure at Casey, Tracy has invested more than $150 million in projects and nonprofit organizations across the country. These investments have leveraged more than $1 billion for thousands of new jobs, affordable housing units, and community facilities. As you can gather from our speakers and the topic here today, we're going to be tackling these issues of impact investment from the perspective of nonprofit organizations. Like I said, there's so many tremendous opportunities these days for nonprofits to effectuate their mission in a much more impactful way, to leverage additional dollars that were never otherwise available, and to do some really creative and exciting things. But of course, like everything else in the nonprofit world, it's fraught with a bunch of legal and tax and regulatory pitfalls and minefields that you have to navigate along the way. We're going to try to explain as much of that as we possibly can in layman's terms here today. And to get us started is Camille. Camille?
Good afternoon. Thanks very much for joining us today to talk about impact investing activities. I'm going to be talking to you about the Nature Conservancy's impact investing work. I happen to actually have a full table of colleagues who I will embarrassingly ask to raise their hands, just so you know who's there, in case you're interested in that. Oh, you just waited to do that. Anyway, I packed the audience with a friendly crowd, but I really would love to have you interrupt and ask questions as they occur as we talk. I'm going to be focusing on the kinds of legal issues that we encounter when we at the Nature Conservancy conduct our impact investing activities. Some are unique to nonprofits, but many of them are actually common to all kinds of individuals and organizations that want to engage in investment activity. So let me make sure I get this right. To start, to give you a little background on the Nature Conservancy, I hope you like our Starry Night slide. We were established in 1951 to conserve and protect the water and land on which all life depends. We work across all 50 states in the United States. We have 35 offices around the world and 4,000 employees. Last year, we generated about $900 million in revenues. So you may well ask yourself, that's some pretty impressive track record. Why are you here to talk about impact investing? You must have all the money you need to conduct your mission. And the fact, I know maybe I'm speaking to the wrong audience, but the fact is we don't. The problems that are facing the world from an environmental perspective are so large, they're so significant, and time is running out. In order for us to achieve our mission, we need to leverage, as Jeff said, leverage resources from a host of sources, the investment community in particular, in order to replicate, build, replicate, and bring projects to scale. And so that's really why the Nature Conservancy launched its impact investment activities back in 2014. And that's through NatureVest. NatureVest is our impact investing unit. It is an integral part of the Nature Conservancy, so part of a 501c3 public charity and subject to the exact same restrictions as the rest of the Conservancy, which, of course, brings its own opportunities, but also challenges. So what are we focusing on these days? This has shifted a little bit over the years. We're focusing on developing soil health technologies, water sustainability, both in terms of the quality of water, so abating pollution, as well as the quantity of water, managing our water resources so we can conserve them for future generations. green infrastructure, which is very relevant to a lot of our work in Washington, D.C., and I suspect people will be talking a little bit more about green infrastructure along the Gulf and a lot of the countries and regions that have been affected by hurricanes. Green infrastructure is a tool, one tool you can use to abate the impacts of hurricanes and help slow their progress across the land. We are also focusing on debt restructurings for conservation. That work is primarily focused on Caribbean nations, which are highly indebted, but they're also we're seeking ways to help them refinance their debt load so they can divert some of those revenues toward conservation activities, sustainable agriculture, as well as fisheries reform. And so that is a pretty big slice, but we're trying to use impact investment tools across all of these areas. So what are the things we actually do with NatureVest, with TNC's impact investing activities in order to bring additional dollars to bear? The first thing that we do is we'll use our own resources, our own capital, to make loans and equity investments in conservation companies. And that's similar to what a lot of organizations do. Let's start with our own capital and prove out, maybe on a pilot basis, a concept. I'm actually going to be focusing more in this presentation on situations in which we're trying to leverage third-party money, because that's really where you start to get into some thorny legal issues. So we look to source third-party capital from outside investors to finance those conservation projects. And that's really where we find we often are beginning to encounter the securities regulation. We're developing investment funds. We may develop a joint venture with a handful of investors. But in all of those cases, we are managing other people's money, and that has implications for TNC both from a regulatory standpoint as well as a liability standpoint. We do provide acceleration grants, seed funding for organizations, and I'm also going to focus on the marketing of financial interests or marketing securities that TNC will do. If we are working with a business, maybe we're an anchor investor in that business, and we want to help them build out and develop to the next stage, we might contribute more equity ourselves or try to connect them to another supporter who can provide that additional or further round of equity. And in that case, again, we have to ask ourselves the question, are we engaging in regulated activity? So the two areas that I'm going to focus on are that were a little bit new or presented questions with a different hue at the Nature Conservancy when we embarked on our impact investing quest: securities regulation. And by and large, most of those were not things or activities that TNC undertook on a daily basis. We're also going to talk about some of the tax considerations, joint venture issues, private benefit, and unrelated business income. Now, of course, all of those issues are relevant to nonprofits. They're issues we deal with every day. However, when you're doing impact investment activity, they tend to you tend to encounter those issues more frequently, and they come up in different guises because of the way that you're interacting with for-profit organizations. Oops. And I'll stay there. So, in the securities context, I tend to deal or spend most of my time focusing on three questions. The first question is, am I involved in a securities offering? Is it in the United States or some other jurisdiction? If so, do I have to register with any regulatory authority? And answering that question correctly is important because if you have to register with the SEC, it is a lengthy, protracted, and costly affair. That doesn't mean people don't do it. People do it every day. However, when you're dealing with fairly high-risk investments in conservation businesses, it can cost you several $100,000 and question whether that's exactly where you want to put your money as opposed to in another manner. At the Nature Conservancy, we've sort of made a general operating decision that where we're creating these conservation businesses, we're largely going to restrict ourselves to what we call private placements. Private placements is the term that you use in the United States when you're conducting an offering to high net worth individuals or organizations. Those people, purchasers, are generally referred to as accredited investors. And the benefit of doing a private placement of securities over retail is that your liability is much lower. Your standard of disclosure is much lower because the SEC is not primarily interested in protecting rich people from their own bad decisions. And in addition, we can have an unlimited number of investors that we go to, and we can avoid reporting requirements under the 1934 Act. So all of those taken together mean that if you conduct a private placement, it's a much less costly, less time-consuming affair. You can focus on actually getting the money into the business and providing that kind of value. The second area, which is actually a little bit more challenging for us, is the investment advisory activity issue. Whenever you, in the United States and in many other countries in which we've worked, you are regulated and have to register with a governmental authority if you are in the business of providing investment advice regarding securities. And here in the United States, you're going to find yourself in the business if you get compensation. For the Nature Conservancy, with the funds that we work with, those go on for 10 to 15 years. It really makes, for us, it makes no sense not to charge something for those services. And so we tend to just bite the bullet and accept that if we are managing an investment fund or managing securities investments, we're going to have to register, again, either at the state level or at the federal level. Now, you do have, did you want to say something? I'm sorry, yes.
Just a quick question. Did you, so taking a big step to manage it's huge to take other people's money and then manage it, right? Did you ever consider, when you were setting up your impact investing strategy, to find outside managers through which you can invest in and still achieve the same objectives?
Yes, thank you for that question, Tracy. And actually, I'm going to talk to you about that example, but that's exactly where I was going, that there can be distinct advantages and disadvantages associated with dealing with an established registered investment advisor. They will likely have the track record in investment management that you lack. I'd say the only disadvantage that we've found in working with for-profit managers is mission alignment. You want to make sure that they have the proper incentives to achieve the triple bottom line. So you don't want a manager that's so focused on their fiduciary duty, which makes perfect sense, but so focused on making money that you're not achieving your conservation outcomes. And the way that we approach this, and I think the way that most people approach this in the social impact space, is to build into your investment guidelines, into the design of the fund or the company that you're investing in, conservation or impact covenants, which ensure that over a 10 or 15-year period, the organization, the company, the fund will continue operating to fulfill both financial as well as conservation outcomes. Thank you. So that is generally what Tracy said is what our approach is at the Conservancy. For now, where we are confronted with the requirement of registering either at the state or federal level, we've taken the position that for the time being, we're going to try to find that third-party manager. If we can't find one, or we feel like we're really going to have to make huge sacrifices on the conservation side, that's where we would actually consider embarking down the road of establishing a registered investment advisor. But it's not just a simple process. It's not overwhelming, but it's an upfront allocation of resources as well as a long-term dedication to changing in some ways how you do business. So that's just something to think about. The third area of regulation that can be challenging for a nonprofit or any organization is marketing securities, raising capital in the form of securities. And we do that for companies we create. We may even offer to do that for third-party companies that we think are doing really exciting things in the conservation space. And I'm looking at one of my colleagues here, who I think I talked to about a year ago. We had some very industrious colleagues who were traveling all over the world marketing securities for a company, and we're like, give us a little background on that. So the big issue is, in our experience, commissions or compensation. So if you are getting a commission, a success-based commission to sell securities, you are a broker-dealer in the United States, full stop. If you are not getting a commission, that does not mean you are not a broker-dealer, and that is the gray. And that's really what the tension that we have. How much activity, how business-like are your operations before the SEC would take the view that you are a broker-dealer. Being a broker-dealer that's unregistered is important. There are not only civil sanctions, criminal sanctions, but also they can rescind the underlying investment, which even if there was no fraud involved. And so that's a pretty, hefty remedy that we are obviously keen to avoid. In our operations, we really work in two ways. We either work when we're marketing securities under a safe harbor that the SEC has established under the 1934 Act. It's called the Associated Person of the Issuer, Safe Harbor. It's Rule 3A4-1, and my colleague Michelle knows that well. It has a number of requirements, things like no commission, continuing involvement in the operation of the company, you're not associated with a broker-dealer in the last 12 months, you're only involved in one securities offering per year. That's not the only basis on which the SEC will say, fine, you can continue doing what you're doing without registering, but that's clearly what's allowed. It's the safe harbor. And obviously, as you hop from jurisdiction to jurisdiction, the rules are going to be slightly different. The one area that's common for nonprofits, but takes on a little bit of a different flavor when you're working in the impact investment space are the tax issues. We tend to find we have a lot of tax issues, and they have to be especially unrelated business, taxable income, as well as private benefit / inurement, which are, you evaluate them up front in the structuring, and then every step along the way as you negotiate with your for-profit investors, for-profit service providers, for-profit managers, you have to constantly evaluate and reevaluate, is the Nature Conservancy providing more than an arm's length benefit? And if so, is this permissible or is it impermissible private benefit? And we find this comes up often in investment funds. When people see a nonprofit, they'll say, sure, I'll put in my equity, but you subordinate yourself. And that could be perfectly fine in many ways, perfectly defensible from a private benefit perspective, but you have to do that analysis case by case. What we've done at the Nature Conservancy is, by and large, our operating assumption is we're going to be establishing these ventures, our financial support at arm's length. So we're going to invest pari passu, and we're going to pay advisors the same kind of compensation that they would receive in any other market fund. There have been situations in which we've been asked to subordinate or asked to provide sort of that cushion, equity cushion, or other kind of subordinated capital, and it could be justifiable depending on the circumstances. But we tend to scrutinize those kinds of relationships very, very closely, not only from the tax perspective, but also reputationally. If you are offering what look to be sweetheart deals to, existing donors, potential insiders, you could create a lot of criticism for your organization and over time undermine the impact investing work that you want to do.
Camille, a couple points and questions for you to opine on. First off, as many of you may know, the private benefit doctrine, which is an IRS enforced doctrine that's applicable to 501c3 organizations, it's a unique doctrine. It's very distinct and separate from the private inurement doctrine, which has to do with paying excessive compensation to insiders. The private benefit doctrine is much broader and doesn't just apply to insiders. It can apply to anyone, including investors that you're dealing with or anyone else that you're doing business with. And the problem with the doctrine is that it's very gray, it's very amorphous, it's very hard to figure out what is impermissible private benefit. So much of what a 501c3 organization does provide some benefit to private parties, and that's okay. You go out and you hire a vendor, a contractor, a consultant to do work for you. They get benefit, they get money from that engagement. They may get a lot of money. That doesn't mean that the organization's tax-exempt status is at risk from having too much private benefit. And so it's a very fine line, kind of where do you cross that line, yet the consequences are severe because the only consequence of impermissible private benefit is loss of tax-exempt status. Of course, that can only come through an IRS audit of the organization, but we have seen it happen, and the IRS seems to have rediscovered the private benefit doctrine probably over the last decade or so. So in your world, Camille, are there any, and you gave some examples, but are any other kind of either key factors or benchmarks or indicia or other things that you utilize to try to stay on that one side, kind of the safe side of the private benefit scale?
I would say that by and large, and I've shared with you our what we call our impact investing guidelines, and it's not a religious doctrine at the Conservancy, but we generally try to establish all of our relationships at arm's length because it can be such a difficult calculation. However, there are circumstances. Go ahead. Meaning wait,
the question was, what do you mean by at arm's length? That's a good question, yes. Patrick.
So at arm's length would be comparable terms of any other commercial actor. So assuming TNC were a commercial investor, what would we insist on? What would we pay? And that would be our metric for determining whether we were providing a private benefit. There are situations in which we have provided a private benefit. For example, a very low interest loan, like a program-related investment. We not only have the protective sort of aura of all of the private program-related investment rules, but the fact is in that case, we were providing a low interest or no interest loan to a new, not nonprofit, but a subsidiary of a nonprofit in Kenya to conduct a highly speculative, vertically integrated cattle processing business, something like that. So it was clearly advancing our mission. It was necessary. Yes.
Wait, just wait for the mic. And while you're waiting, just so everyone's on the same page, the private benefit test, if there is a test, is basically in a particular activity, does the benefit to the public, in this case to your conservation mission, outweigh the private benefit, both quantitatively and qualitatively? Quantitatively is basically a balancing test, and that example you just gave, clearly I think there's a strong argument that the public benefit outweighed the private benefit in that situation, particularly because it wouldn't otherwise be easy for the investment dollars or other dollars to flow in to support that kind of venture, which has a strong conservation purpose. The qualitative test is the private benefit no greater than necessary in order to achieve the public benefit, and is it kind of necessary and incidental in order to achieve the public benefit? That's the little trickier one sometimes to analyze, but it's a really important one. Again, there can be some private benefit, but we don't want it to be any greater than necessary in order to achieve the public benefit. You have a question here?
Yes. I was wondering if you could distinguish in the rest of the talk between issues that only are for activities in the U.S. and issues that occur when it's abroad. Also, I assume that delineation is based on what you're investing in, or is it based on the location of, say, a firm's registration?
Well, I would say the securities laws, obviously, I'm a U.S. lawyer, but I play a non-U.S. lawyer on TV. They do have almost every jurisdiction I've encountered in Europe, in Canada, in Australia, in the common law jurisdictions and most of the civil law jurisdictions you have to ask yourself the same questions. The answers may be slightly different, but you have to ask yourself the same questions. And I would say the tax considerations can be a little bit more complicated, but because it depends on whether or not this is a related organization. In some cases, we carry out our impact investing activities through subsidiaries, but these are often nonprofit subsidiaries that are controlled by the Nature Conservancy, so they roll up into our 990. The way that TNC is organized, 100% of our policies and procedures here in the U.S. apply across the board to every single related organization and every single employee. And I think that is both to be, on the conservative side of the legal interpretation, but also prudentially. We don't want, our affiliate in a foreign country doing something that would be on the front page of the, New York Times or Washington Post here in the United States, because, the fact that it's a subsidiary technically is just not really going to pass muster.
And everyone should keep in mind, too, that the U.S. tax laws that apply to 501c3 organizations apply equally to your activities both domestically and overseas. The same tests apply, the same analysis applies, regardless of where the activities are being carried out. Obviously, what Camille's talking about is when you're not carrying out the activities, say, through the Nature Conservancy, but through some other entities, they take the position that they're all one and the same, even though in some cases that may not be the case. But certainly, if you're engaging in activities overseas that could risk some impermissible private benefit, it's just as much of a risk to your exempt status.
Quick follow-up. Is there any country, or would you give an example of a country where you wouldn't touch it with a 10-foot pole, where, the issues of the regulations or the reputational risk is so high?
No. I mean, we do business in 35 countries. Some countries were on the Debarred List. We really follow the conservation mission. And we will take the risks that are necessary in order to achieve our conservation purpose, but we're going to be mindful that every situation prevents different risks, and it's a cost-benefit analysis.
Camille, can you talk for a second about, we have in the slide under tax considerations, joint venture risk. So we've talked a lot about private benefit, and sometimes the analysis with kind of nonprofit, for-profit, joint ventures, and the private benefit analysis is very similar and related. But it is, a different analysis, and I know you guys are very good and have very strong policies in helping that you also kind of stay on the right side of the kind of joint venture analysis. Do you want to talk about that for a minute?
So for our impact investing activities, the joint venture issue presents itself when we're co-investing with other organizations. And these are not passive investments on our part. The key question that we ask ourselves is, does this joint venture, let's say we're entering into a limited liability company joint venture with for-profit investors to carry out, technology development, that's an example, soil health technology development, to be specific. In that case, the question is does that venture substantially further our tax-exempt purpose? And that's not a subjective analysis. We have to look at the governance and the level to which TNC as a charity can control that whole organization, or perhaps just the achievement of the conservation goals. And if it's sort of a straight equity investment, maybe we're 25%, we have some voting rights on the board, some minority shareholder rights, but you really can't say that TNC controls that venture or even its conduct, the development of its technologies, for example. Then I would say that means that at least that venture it may have to, depending on what it is, may have to be reported on our 990. I think it also can sort of be a tip-off to the IRS that you may have some unrelated business activities. Chances are we're going to recognize that income as taxable income, maybe put up a blocker corporation to deal with the taxable income. For us, we're tax sensitive. And ultimately, we don't want unrelated business joint ventures to predominate, or that could ultimately, over time, as they grow, threaten our tax-exempt status. And I would go beyond that, I would turn it over to Jeff.
So just to put a little more color on that. So the IRS put out some guidance, I don't know how long, maybe 15 years ago, on joint ventures between nonprofits and for-profits, focused on the healthcare industry where a lot of that takes place, as you may know. And they distinguished between kind of whole entity joint ventures where basically all parts of the nonprofit are doing some kind of a joint venture with all parts of the for-profit, or at least all parts of the nonprofit, and then ancillary joint ventures. And what we're generally talking about here are the ancillary joint ventures, where it's one particular program or activity or investment of the nonprofit that's at issue. And what the IRS said is that if you want to avoid the income from that venture being treated as taxable unrelated business income, and just as a refresher for all of you that may know, most of you probably know, activities that substantially further your mission and your purpose as a tax-exempt organization are going to generate related tax-exempt income. Even if some activities don't fit that bill, there are a number of exceptions and exclusions to unrelated business income, like royalties and dividends and interest and annuities and certain rental income, largely if the activity is passive. If you're not playing an active role, you just invest your money in mutual funds and you get some returns. That's all going to be tax-free because it's passive. It's an exclusion to unrelated business income. But in the joint venture context, say you're a member in a multi-member LLC with several other investors, your nonprofit is, and you want to take a more active role, what the IRS says is that the tax-exempt organization has to maintain not necessarily a majority decision-making control over everything in the venture, but it has to maintain majority decision-making control over those aspects that go to your mission and your purpose. So when in your context in the Nature Conservancy, it has to do with the conservation purposes. So if there are judgment calls to be made, the Nature Conservancy has to have 51% or more decision-making control over those purposes. But as to other aspects of the venture, more technical things, other things that don't necessarily go to the conservation purpose, the IRS says you don't have to have majority decision-making control. And TNC has done a good job from what I've seen in negotiating. You can't always negotiate it, but negotiating that majority decision-making control, even in cases when their equity stake is less than 51%, but just insisting on it. And many investors, believe it or not, will be accommodating to that. But that is the kind of the safest way to help make sure that the income from those ventures doesn't get treated as unrelated business income. All right, enough interruptions. There's a question in the back, but we do need to we need to keep this going. It's my fault for sidelining Camille. But one quick question in the back, and then we'll move on.
I was just going to ask how you differentiate between equity in the whole business versus equity in certain parts of decision making.
Well, I think that we generally take equity in the whole business. I mean, assuming they're not setting up a subsidiary to execute this special purpose company. But what you would do in a traditional, let's say, in most cases, because as I've said, TNC is looking to aggregate capital and not be the sole, source of capital. In the vast majority of cases, we're not going to be the 51% investor, as Jeff said. However, it has to do with your shareholders agreement or member operating agreement. You're going to negotiate certain voting rights. And let's say in the typical operating agreement, voting rights will be allocated pro rata associated with your equity contribution. And that's perfectly fair in the commercial world. However, because TNC is we're not involved just to make money. We're involved to advance a conservation purpose, or we wouldn't make the contribution to begin with, so we will reserve voting rights. So, for example, we might reserve to ourselves, I'm trying to think of a good example, we might reserve to ourselves a decision to donate or allocate a specific portion of the portfolio of assets to a conservation purpose. One of the things I was going to talk about later is an investment fund that we launched in Australia that invests in water rights. So those are just an example. It's where the enterprise has to make a decision. There's a tension between a conservation activity which might yield slightly lower returns or lower returns, And that's where TNC would like to focus its energies. So maybe if we're looking at a timber management fund, TNC would be the certifier. We would determine whether this particular tract of land presents high conservation value and therefore is worthy of acquisition. Those kinds of decisions would be allocated to TNC or the charity in that case. But it isn't. It's not. It's an art, not a science.
Yeah, and Camille, if you can try to kind of go through the rest of the slides quickly and just highlight the ones that are most important. But one last, the bottom point there, just keep in mind, to the extent that you are co-investing with insiders, as Camille said on her slide, officers, directors, employees, their family members, folks like that. There are additional risks that come into play, both the private inurement doctrine, the tax doctrine I alluded to earlier, as well as conflicts of interest law.
So I was going to talk about how we've dealt with a lot of these legal issues in the context of a water fund. You'll note I actually haven't named it, which is kind of silly, but it's in the course of an offering in Australia, and I just want to be really, really careful about not breaching the Australian securities laws. So it was called the Murray-Darling Basin Balanced Water Fund, and it basically invests in a whole bunch of water rights in Australia, and they donate a portion of the rights and revenue every year to conduct environmental watering in sensitive wetlands in Australia. So we think it achieves the triple bottom line, financial returns to investors, which is also beneficial because it promotes the monetization of water, which ultimately we think is necessary at TNC to conserve it. You have the conservation outcome with the donated water, and you also have the social return because we're actually watering in culturally significant lands for indigenous communities in Australia. And so that's a picture of the Murray-Darling Basin. And I'm just going to flip through to show you the roles that we played on this fund. Anchor investor, we were a fund sponsor. In the U.S., you would call it a promoter, which means we help put this together and conduct the offering. We help market the interests. We did have a broker-dealer on that deal. And we conduct ongoing oversight of environmental and social outcomes. To Tracy's question, this fund is managed completely at arm's length by a third-party investment manager called Kilter Rural. They handle all of the regulatory work as well as the investment profile of the business. I would just say if you're looking to develop an investment fund or any other impact investment venture with third-party capital, keep in mind that there are some significant costs associated with it. We've had to put in a lot of upfront money to pay for legal fees, accounting fees, tax advisors to make sure we're structuring the fund optimally. Third-party investment managers can do that work, but if it's a very innovative concept, they won't do that work. And so that's really a catalytic role that we can play. You have to bear in mind there is liability associated with securities offering. Even if you think you didn't do anything wrong, the SEC or investors may take a different view. And third, reputational management. As with any impact investment activity, you don't want that investment activity to undermine your broader charitable purpose. It's there to serve the charitable purpose and is not a means and end to itself. So those are just some of the issues that we grapple with. And thanks very much for your questions.
Thanks, Camille. Javid?
Thank you. Appreciate you giving me a moment to get technically squared away here. Thank you. My name is Javid Fruzan. I'm with the Leukemia Lymphoma Society. I first and foremost want to thank you for inviting me to participate here. LLS.org is the website. We'd be happy and pleased to have you learned more about activities where you can help LLS raise funds, or if you and your network have donors interested in moving the needle on blood cancer, would love to get in touch with those people as well. So I have been with LLS since November of 2016. I was in industry prior to that, and I'm going to say, for setting context, that many of the issues that we're dealing with in the not-for-profit world are very similar to the issues I dealt with in a for-profit, publicly traded company, with the exception of not-for-profit status. So I just wanted to set the tone that much here is familiar, and then there are some unique things that you have to take into account. Let me just see if I can get this right here. Okay, so LLS's mission is all about blood cancer, moving the needle on blood cancer. So for over 60 years, LLS has been funding innovative research and providing services to help accelerate cures for blood cancer. And we're really seeing, especially in the last 5 years, definitely over the last 15 years, that the tide is turning in some of these very horrific cancers that impact children and adults. The bottom line of this particular slide, number 15, indicates that LLS has had a role in many FDA-approved blood cancer therapeutics. So we'd like to appreciate the support that people have provided LLS. Okay, so when I look at LLS, what I see as somebody coming from for-profit enterprises, I see a not-for-profit, patient-focused biopharmaceutical enterprise. So many of the functions that LLS has are similar to the functions that we had in a fully integrated biopharmaceutical company, with the exception of LLS is not focused on marketing and selling its own product. It's marketing and selling vision, which is moving the needle on therapies and cures, and it's using its funding and its position to basically fund researchers in academia, fund small biopharma companies, and even to get large biotech and biopharma companies, including publicly traded firms, to play in the same sandbox together. So as I go through these slides, you'll see that there are a number of innovative ways that LLS indeed is working to discover, develop, and commercialize new therapies. Oh, let me go back one slide. So LLS as an organization does not have a huge endowment, so we're not like Cystic Fibrosis Foundation, which has a multi-billion-dollar endowment from a recent success this past few years. LLS raises over $250 million per year, mostly $75 mom-and-pop contributions based on campaigns and specific events. So every dollar counts for LLS, and 60 to 80 million per year goes into research, and the remaining portion of my presentation is focused on the research side of LLS. So the research team, through a peer-reviewed call for proposals, basically is putting out order of magnitude $40 million a year in academic research grants. I've listed the name on the left-hand side. Probably the key grant to know about in terms of the ones having the most impact are the Specialized Center of Research, or SCORE, collaboration grants. These are typically 5-year, $5 to $6 million grants, which are cross-functional within departments where academic research centers are setting up within their institutions, and sometimes across institutions, a consortium of researchers to work on specific projects as well as core capabilities and functionality. And the smaller awards range from $600,000 a year, $600,000 to multi-year grants over 3 years, to even $75,000 to $100,000 1 or 2 year grants. So it's a broad range, and the 2 scores in particular. One out of Western in Australia has led to an approval back in 2016 of Venclexta by AbbVie and Genentech, and that was over a 15-year plus relationship. So LLS contributed funding, companies contributed funding, and it really just shows you how long the drug development cycle is. And then another score produced a CAR T-cell therapy, which just got approved this past few weeks by Novartis, where LLS, again, funded $8 million in direct CAR T research, and then on top of that, another $7 to $15 million of incremental spend that was around core capabilities that enabled that. So 2 recent successes, again outlining the commitment and the level of effort and time it takes to actually move a drug through to development and approval. The Beat AML Master Trial, acute myeloid leukemia, is an initiative where LLS actually holds the FDA IND. So LLS is the sponsor. Multiple companies are participating, and you can see some of those companies listed there, large for-profit biopharmaceutical firms. And basically, the focus of the trial is to use genomics to determine which drugs patients should be on in combination therapy as part of evaluating multiple drugs that could be of value to the patient. So we're really letting the patient's genomics and their response to the drug dictate and determine which arm they're in, and if it's not working, but there's another combination that might work, there is the ability for the patient to switch arms within the trial. So very innovative in terms of, one, the design. There are not too many trials set up in this fashion. And then secondly, very rare that you can get companies to work together with other companies having access to their drug, which is not yet approved by the FDA. I know from experience in attempting to partner clinical stage oncology candidates when I was in industry, you may have had great preclinical data with another party's compound, but the minute that they were in the clinic or on track to get an approval, they wouldn't let you get access to the compound to actually run combination trials. So this is an innovative way that LLS is truly moving the needle in blood cancer. The next area, the Therapy Acceleration Program, is a program that's been in existence 10 years. $100 million has been invested, or I should say funded, because not all of these would classify as investments. But it's a rolling program where if you have, whether you're a company or you're an academic researcher that has a clinical stage opportunity, meaning drug candidate ready to move into the clinic within a short period of time or actually in the clinic, you have the ability to work with LLS to obtain funding. You'll see right smack in the center of that bullseye that a company called Celator was, which had been acquired recently by Jazz Pharmaceuticals. They were funded by LLS back in 2009 and 2012, so at the height of the financial crisis, at the depth of the ability to raise outside capital. And both their management as well as their shareholders indicated that but for LLS funding, they would not be able to move their product candidate ahead. So that was just approved by the FDA this past month or two. We've got a couple of other opportunities that you'll see that are moving in on the bullseye. So if you look in the phase 2 ring, you'll see Kite Pharma there on the upper right quadrant. It's a phase 2 breakthrough designation CAR T-cell therapy, which is in front of the FDA for review right now. So we're excited about that. So that'll be another LLS victory, if you will, for patients. And you'll see on the bottom that I specifically cite a VC venture in the preclinical space. That's a convertible note that I negotiated this past spring. And you'll see something that says founder/angel venture. LLS took an equity stake in that particular early stage company. The note holders had already converted into common stock, so we decided to go in at the last valuation of that conversion. Okay, so why do companies and institutions, meaning academics, use LLS as therapy acceleration program? I'm going to focus on this because this is where you have opportunities that are closest to the clinic or in the clinic. So we're looking to move the needle on blood cancer, so obviously focusing on the clinic is where we want to maintain the focus. We want to accelerate first-in-class therapeutics. So LLS is not concerned generally about best-in-class. We want to move the needle on new therapies, first-in-class. Secondly, there are some rare diseases in small markets that, but for LLS funding, companies which have large pipelines or scarce funds or both, they're not going to prioritize. So Kite Pharma, as an example, although they were well-funded, and they were moving through development and some nice large blood cancer indications, they were not pursuing some of the more niche indications where they could generate a return, but the opportunity cost was too high without some other party giving them an incentive or an inducement to actually pursue it. So that's the prioritization point. And LLS has a lot of value-added resources through its network where companies such as Celvita, a Polish-listed publicly traded company just getting into drug development after being a successful service provider to larger pharmaceutical companies, they don't know the U.S. market well. They don't have the network, but they've got great competency in developing solid preclinical drug candidates. So they need somebody like an LLS to really provide value and access to the network. And then finally, funding might generate a financial return to fund future research. So LLS is not focused first and foremost on generating a financial return. I would say of the $100 million that was invested in the therapy acceleration program in the last 10 years, roughly $60 million of that or so has gone to companies, the remaining to academics. The returns have just started to come in over the last year or so. So 30 million or so order of magnitude has come back in. So out of the 60 million-ish into companies, 30 million has come back. I have not yet sat down and determined what the ROI is based on the timing of the outflows, because LLS funding typically goes out in tranches based on milestone achievement and in addition to product-focused collaboration agreements where LLS takes its return on the back end as companies and products move through the pipeline and have success, LLS will get its share. LLS also has equity, rights to equity, such as convertible notes, and a targeted funding model where on the product-focused collaboration agreements, LLS funding is order of magnitude 15 to 25% cost of capital, and on the equity and rights to equity and other is whatever you pay and negotiate and however well that investment does or doesn't do.
Javid, question for you, and we've got about 5 minutes and we need to move on to Tracy, but I know that a lot of investors look to LLS because of your successful history in doing due diligence on particular potential research investments, and I know you guys have always struggled with or balancing kind of the securities law considerations that come into play with in that area. Do you want to talk about that for a minute?
Yeah, thank you. So this next slide shows that LLS uses a standard stage gate process to perform due diligence. So most of the major pharmaceutical companies will do a similar type of diligence where they're moving opportunities through a funnel. One of the concerns that we have when we look at outside funding and opportunities is with respect to reliance on diligence. So I have been very clear that regardless of the funding model, that my own perspective and the organization has bought off on this is that other parties need to do their own due diligence in terms of not relying on LLS's technical diligence. So when we look to work with other organizations, first and foremost in the TAP program as an example, companies need to have skin in the game. LLS is not funding 100% of the project. These companies have to put in typically 50% or more of the funding. So that's the first thing that we're doing with respect to TAP. Secondly, as you look at the top of this particular slide, number 22, and I think this is my final slide, we're putting in place a separate legal entity to basically ring-fence liability. put our assets into, in addition to having better transparency on flow of funds. LLS will look at mission-focused single project newcos that we'll set up, and we'll take in smart money that makes sense. So, for example, if a venture capital firm or angel investors that are life science focused, or even companies want to set up a special purpose entity and place assets in it that is focused on blood cancer, meeting our mission, we'll take a look at that. We are not at this point in time looking to have donors participate in those particular entities. We don't think that it sends the right message. And how do we decide who to pick or not pick in terms of including or excluding? And we don't want to get involved with all the regulatory issues related to being a promoter and the compliance issues that come with that. So if you can hold your question another moment. The other thing is we've determined that we're not going to set up a separate venture fund at this point in time, not only because of the regulatory issues that were outlined earlier, but because of infrastructure and reporting and metrics. You know, LLS just isn't there. So LLS started on the grant side, where if the universities were monetizing and are monetizing technologies that they outlicense or set up newcos, LLS will get a small portion of the consideration they receive. But it's only the last 10 years in doing the therapy acceleration where LLS has started to be more proactive in a real venture philanthropist way. So the infrastructure has been built around grants and other parties doing the monetizing, and LLS has a major effort that I'm initiating in the area of grant compliance, because as all these other parties are monetizing, LLS needs to make sure that it's getting its fair share that was negotiated previously. And the other thing is that we want to make sure that mission and philosophy are not impacted. So if we're looking at setting up some type of fund, and we've been approached by venture capitalists to set up a fund, do they have the same orientation we do with respect to blood cancer? So that's a very major concern in terms of, do we have the alignment as was talked about earlier? So did I answer the question?
You did. Okay. You did, and that was perfect. Yeah,
go ahead.
Go ahead. Camille has a question.
I was curious. You just talked about setting up a special purpose company, a subsidiary, to conduct certain operations. What were the liabilities in particular that you were looking to ring fence away from LLS? Yeah,
thank you. So with many of the academic therapy acceleration programs in particular, LLS had a pretty active role in terms of managing the project. As you can imagine, a lot of these principal investigators at academic institutions are not drug developers. So LLS not only was having an active role in terms of directing the project, but also has been doing direct contracting with preclinical CROs and manufacturing of material with contract manufacturers. So, there are a series of activities that LLS has undertaken, which I think that as you look at candidates going into the clinic, raise some red flags from a risk perspective. And then if you look at returns that LLS is getting, for example, from universities or from companies directly, where products are now not only in the clinic but actually approved by the FDA. FDA-approved products on the market almost always generate some form of product liability lawsuit. So LLS is wanting to ensure that we're able to contain liability as much as we can, plus the fact that where there's money involved in returns, there's always the potential for some form of lawsuit when people are looking to stake a claim in some way, shape, or form.
Yeah, we should have mentioned that earlier. We talked a lot about securities regulatory issues and federal tax law issues, but in a lot of these impact investing and social impact related activities, there are liability concerns, from product liability lawsuits to all sorts of tort liability suits that can arise. And so it is very common in the nonprofit world to use different other legal entities, LLCs, for-profit subsidiaries, other sorts of blocker corporations to, as you said, kind of ring fence and put a box around potential liabilities to help protect the underlying organization and its assets.
Yeah, and the final thing I would say, and thanks for that comment, is that I've upgraded the professional staff in terms of types of consultants that LLS uses. So I've got former Pfizer, former Wyeth professionals helping me on the business side. On the legal side, engaging more life sciences experienced counsel to help negotiate agreements. And, clearly there's a lot of infrastructure and systems that need to be upgraded as well. So that's an area that we're focused on, and appreciate your comments. And, we hope we can work together to move the needle on blood cancer.
Thank you, Javid. Tracy?
Good afternoon. It's a pleasure to be here with you all today. And I was just thinking it's a pleasure to be on a panel with people who do investing in such a dramatically different way than Casey does. I tend to spend a lot of my time in the community development in the United States. And so to hear about the work of the Nature Conservancy and LLS is really, really interesting. I wanted to really target my comments in some ways to a higher level about impact investing, kind of using what Camille and Javid have spoken about. I think already will illustrate some of the points that I'd like to make. But I'll start with setting some context about the Casey Foundation. So the Annie Casey Foundation was established in 1948 by Jim Casey, who was the founder of UPS. It's named after his mother. Our mission is to build brighter futures for vulnerable children throughout the U.S., and we have a pretty robust grant-making strategy that addresses issues around strengthening families, building communities. We advance research and solutions to help overcome barriers to success. And then we also support communities as they seek to demonstrate what works through evidence-based strategies. So that gives me a great deal of space in which we can think about how do we apply impact investing to our mission. For much of the same reason that Camille laid out, Casey started making impact investments. We refer to it as social investments because we started before the term was coined, and we just haven't changed. But we really felt like if we wanted to impact children and families, our $3 billion endowment just wasn't going to be enough to do that. Or what we could do through our payout rate annually. So we targeted an allocation of 4% of our endowment for impact investments. So we're a little bit unique in that we do all of our impact investing out of our endowment. Many private foundations will make their program-related investments out of their grant-making assets, and then we'll dabble on the market rate side in their endowment. But we felt it was important to house all of this in our endowment so that we could make that connection between what we're trying to do on the mission side and what we are doing on the investing side. So we seek a financial return as well as a social return on each of our investments. But because we're investing in a number of different sectors, we're pretty flexible in how we structure the different investments that we make. You can see that in terms of sectors, we're heavily invested in housing and community development. We have a strong exposure to economic development activities, but we've dabbled in the child welfare space, education, as well as access to responsible financial products in the U.S. And I think we've been fairly effective at what we've been trying to do. We have deployed $160 million cumulatively over the last 15 years. And in turn, we have seen some form of leverage and co-investment that exceeds $1.5 billion. So that means that is capital going into the communities and into the projects and into the organizations that are doing really great work on behalf of families and children in the U.S. And we do this in really strong partnership with our grant-making program staff so that we're sourcing the right kind of impact opportunities. But as you know, it takes a lot to manage a portfolio and ensure that we are doing what we need to do in order to comply with our fiduciary responsibilities. So to take it back up to a higher level, I think what you've heard so far is illustrative of the fact that there's more than $77 billion in impact assets currently. This is a number that was identified by the Global Impact Investing Network last year as part of their annual survey. And impact investing is really being defined as investing with an intention to achieve a positive social or environmental impact, or both at the same time. And there are a range of financial expectations, and you can make an impact investment in virtually every asset class that exists. It depends a lot on who you are and why you are investing. And I think we've heard a really good example of who are the impact investors. It's not only private foundations and public charities, it's high net worth individuals, it's fund managers, it's regulated financial institutions that are trying to make a difference with the capital that they have to bring to a particular challenge. Moving on to the different types of asset classes that you can invest in, this is a chart that I like. The Hef-B Heron Foundation created it many years ago, but I think it still has a lot of relevance for us today. What I really wanted to illustrate with this is that flexibility across impact classes and how you can find opportunities that are going to be aligned with whatever your interest in impact investing is and the strategies that you want to deploy. Just in terms of the continuum, we can put it on a financial return expectation. And as you're looking at this slide and it points to the right, those are asset classes where you can, that map to traditional market rate asset classes. So you're investing for a risk-adjusted market rate return, either through fixed income, public equities, or private equity. And then on the opposite end of the spectrum is where you begin to look for a concessionary rate return on a risk-adjusted basis. So here we've heard examples of how you might invest in venture capital or private equity for that, and you can get a market rate return on that because of the level of risk that you're taking and the opportunity to recoup that while achieving a positive impact. But at the same time, you can also do that on a concessionary basis. So, for example, Casey has invested in first-time fund managers that are embarking on a brand new strategy that is seeking an impact objective, and we've found a way to structure it as a program-related investment. The last time we did that, it was not easy, but it was feasible. And just a note on program-related investments. For private foundations, that's really the only impact investment that has a definition. It was defined by the IRS that allows us to make investments without it being a jeopardizing investment because we're taking that concessionary rate return. So it has to meet certain criteria. So, for example, you demonstrate that you're making you're making the investment primarily for that charitable return. And then there's some other considerations, like there's no lobbying, very similar to what you see on the grant side. And in part, this is because when a foundation makes a PRI and pays it out, it counts towards our charitable distributions. It becomes a negative distribution when we get repaid, but it's all part of the consideration that we have on the PRI side.
And just to clarify for everyone, these rules are applicable to private foundations, not public charities. I know most of the attendees for this program come from public charities, but these are the rules that are applicable to private foundations like Casey.
Yeah, and that's a great point. And what I've seen is that PRI becomes more of a general term for these concessionary rate investments, and private foundations have to pay a little closer attention to it. So really, I think what you've also heard today is that your motivation for getting into impact investing really drives your strategy. And that is, I think, one of the reasons why this field can be so confusing for people just getting into it, because everybody's strategy is different. They might be investing, if it's a public charity that like the TNC, that recognizes a need to leverage and aggregate capital in order to achieve their mission, then that might be, that's going to define how they go about doing it. If it's a public charity that also has an endowment that just sees an opportunity to align their mission with their investment strategies, that might drive a different type of impact investing strategy. And so there are just a range of ways in which organizations engage in impact investing, but they all are driven by kind of similar considerations. So what's the mission of the organization? What are they trying to achieve by getting into impact investing? Are they going to do this in a strategy because they want to preserve their capital and build their resources to invest at a later date? That might drive a market rate strategy where they're really trying to maximize financial return while getting some mission-aligned impact. Casey is what I would say a mission-first investor. We don't make an investment unless we can make that connection to the foundation's mission. And then, and while we seek a financial return, I don't have to manage to a very high financial return benchmark. So I have a lot of flexibility in terms of whether or not I'm doing a market rate or a concessionary rate investment. And so, those are all real considerations. I think risk tolerance is another important consideration that organizations have to walk through. We have, my anecdote on that is I keep asking our senior leadership what kind of a loss ratio they'd be happy with and willing to accept, and I never get an answer. And so I guess they'll tell me when I hit it. But we make some pretty risky investments, in my opinion. We will go into, we have supported startup social enterprises, for example, that basically grew out of the foundation. But because the foundation was putting grant support and a lot of technical assistance into them, they felt like that was a reasonable risk to take. So those considerations have all been an important factor for Casey and for others as they enter into this space. Just because it is impact investing, I think it's not, I think you've heard this already, it's the approach to making the investments really isn't that different than what other investors will do. There is a robust due diligence process. We want to know, what is this investment? What's the likelihood of success? Are we going to get our financial return as well as our social return? What is the risk that we won't? And understanding all of those factors in advance are really critical pieces of the work. We want to understand, is there a viable business model? Is there a management team in place that can execute? And that's true whether or not we're going into a fund or we're doing a direct investment. I think, we're pretty fortunate in the U.S. because we have a really robust community development financial institution industry, if you will. So these are mission-driven nonprofit loan funds that are investing in communities. And so we find a lot of synergy with them, and we don't have kind of the challenges with them in terms of mission alignment, and are they really are they going to put mission first and kind of take the risks that we want them to, that conflict just isn't there that we might have with for-profit investors. But we still need to understand, what they're capable of and know them really well. And once we get to the point where we're ready to make an investment, we have gotten creative in how we structure things. Sometimes with our CDFIs, we've figured it out, and we have a pretty standard approach to structuring our private debt. But sometimes we go into new structured funds. We subordinate. We will provide credit enhancement in certain situations. So when we do that, we have to think creatively about what are those structures and how are we going to engage with our co-investors so that the project or the work is really positioned to use the capital well and to succeed. And that sometimes can translate into high transaction costs or unconventional terms, all of which get factored in some way. And then on the post-investment side, there is, it doesn't go away. We continue to monitor. We continue to engage with our fund managers and our borrowers so that we are able to adjust if necessary to get the social impact, or intervene if there is a financial challenge, or just be able to report back to our board, who is very interested in how we make our investments. Just to give you a sense of what this looks like when it plays out at Casey, we have, subordinated in real estate transactions in order to get banks to the table to provide the large amounts of senior debt that are often necessary. One example is a fund that that finances permanent supportive housing across the country. The innovation actually with this fund and our subordination was that they scaled it up, and it meant that banks relaxed their geographic investment restrictions, which, given the Community Reinvestment Act, is often a primary consideration for banks who are investing in these types of strategies. We have our private debt. Our senior loans are often to CDFIs that are doing small business or micro enterprise lending. We provided first loss capital on a large bank pool that's used for homeowner or owner-occupied rehab in changing communities. And then we have examples on the market rate side as well. And actually, I can talk a little bit about that last example. I've provided just 2 examples to kind of put a little more detail to it. We made a $2 million 10-year loan to a CDFI in Maine called Coastal Enterprises. They are mission-driven to create economically and environmentally healthy communities in which the people of Maine are able to thrive. They raised a total of $13 million. They actually invested a total of $27 million. So what you see there is that they had the capital long enough to recycle it into new investments. And that capital was really meaningful for Maine, where they invested, because they were the most economically distressed communities in the state. So creating almost 4,000 jobs, putting hundreds of affordable housing units into the marketplace is really meaningful for that state. And then finally, this is the market rate fund that we invested in with SJF Ventures. They're actually on their 4th fund, but they seek to invest in high growth companies with a triple bottom line. So they're not only seeking to achieve that market rate return, but they're seeking a social benefit through the quality job creation that they're supporting through the portfolio companies. But also they're investing in portfolio companies that often have an environmental lens to them. Which could take a number of different formats. They have fully invested that fund and to date have created more than 700 jobs through their portfolio companies that are locating largely in low-income communities. I use those indicators because those are the indicators that KC is most interested in from a programmatic perspective, even though we think that the fund overall does more than just that. So with that, I can turn it back to you, Jeff, or is there any questions?
Thank you. Any questions here from the audience or on the webinar for any of our speakers? And advance the last slide.
I have a question for my fellow panelists. Transactions, and we're in the transaction business when we're funding, have cost. And I would be remiss if I didn't ask if you do any cost sharing with either your partners who are helping you to fund or the recipients of funds, because I'm getting questions as I upgrade LLS's transaction infrastructure and professionals on should we be having the recipients of the fund, pay some of the proceeds toward transaction costs. So have a question. That's a question for both of you.
So we have asked our investees to participate on the costs of the transaction, but that has typically been driven by our co-investors in the deal. We often, if it's just a KC investment, we will not ask them to cover our legal costs. They have their own. They have their own legal costs. What we will do as a private foundation who's very interested in getting others to invest alongside us, we will often share costs associated we'll share legal counsel, or we'll, if there's a consultant doing diligence, we'll share the cost of that.
And I would say at TNC, we do look to leverage our pro bono relationships, of course, but in some cases, like in Australia, there were hundreds of thousands of dollars in legal fees. So we did seek to get some of those fees reimbursed, but again, over time and based on the success of the fund. We're not looking to, drive down the IRR in the first year simply to get our money back. It would sort of be self-defeating. So.
A question from from one of the webinar participants, I guess for Tracy initially, but for any of you if you want to chime in. So the questioner is wondering if you're making mission-related investments from your endowment and you're expecting to get kind of subpar returns, less than market rate returns, are you worried about, have you ever considered kind of the fiduciary duty issues, and are you in breach of those duties?
So the IRS, in addition to, so if we're taking a concessionary rate, we will document it as a program-related investment. So from that perspective, we do not feel like we are in breach of our fiduciary responsibility. But the IRS did come out with guidance for foundations and pensions that allows or supports our ability to consider our mission when considering making an investment. I mean, I think there is, when you defining what is market rate is very subjective, because it's how you document and you perceive risk. I think the challenge that I come up against in the investment office at Casey is that I think we've moved away from is defining market rate as a relative consideration. So am I considering a private equity manager that is, a newer fund? It's, it has a good strategy. We think it can return 20%. But my colleague on the private capital side, it's not a fund that he would consider because he has for his portfolio an entirely different investment thesis and access to managers who consistently get, 25% returns. So being able to rely on the IRS guidance has helped us address that particular issue.
Okay, thank you, Tracy. Well, seeing no other questions, I want to thank our. Sorry, we do have one more question right here, and then we're going to wrap it up.
Real quick, this is also for Tracy, but other folks may have some thoughts. Tracy, I'd like to hear you talk about when you're making these investments, how you go about creating metrics by which to measure the social impact of your investments, and then what role those metrics have in the deals.
It's a great question. The way Casey works is that I usually drag in one of my grant-making colleagues to help us identify what are the impact metrics that we should, that are really relevant to Casey. We do look to, there are some industries, different organizations like the GIN has created the impact IRIS metrics, I'm forgetting the acronym, what it stands for, that have tried to standardize different metrics that you can use for the type of investment you're working on. There's the Impact Project, which is an initiative that is also working towards how do we create some standardization around impact metrics that makes it easier for investors to evaluate and think about the social return. So for us, we don't try to quantify what that social return is in any way. It's really based on the way we do it is we set an objective or a target, and then we measure progress against that target as an indicator of, are you doing what you said you would do? Do we think we're going to get the social return? And if not, why? So we've been involved in deals where we didn't get the social return that we expected, but it could have. So one deal in particularly, it was about commercial revitalization of a community, and the market dropped. So nobody wanted to borrow capital for Main Street facelifts, for example. So in that case, it was less of a concern, where we might be more concerned in a situation where they're making loans. So say they're building affordable house, or they're building housing that's affordable, but it's affordable to, they're really focused on 120% of area median income, where we really like to see closer to 60% area median income. So that would be a real concern in terms of, are we getting the type of impact that we wanted to achieve?
Camille, if you can give us a last word on this in terms of how does a nature conservancy measure your kind of conservation impact? Are there any standards, benchmarks, other things that you found helpful to your organization?
Well, we build it deal by deal. At the end of the day, it is very bespoke, but we build those in. If it's a loan, we build them into covenants and reporting that the organization has to do. So just as an example, we provided a 10-year loan to a Kenyan vertically integrated pastoral cattle processing facility. And so the number of cattle that were involved was a metric. The number of communities in this area that participated was a metric. The amount of landscape or grasslands that were preserved was a metric. So all of those can come together and form a goal. In the United States, if we're working with forestry, we might look at, restoration of habitats, or the amount of land that is under long-term conservation at the end of the fund. So those kinds of things. But it is very much project by project, and we would seek to bake it into the terms of the deal and would be enforceable.
Thank you. And thank you to all of our panelists, Tracy, Javid, and Camille, for a terrific job. We really appreciate your participation. Thanks for all of you for joining us, and hope to see you back here next month. Thank you.